market is concerned, the local market took a turn for the worse today. We saw some positivity in the start of the week, but today down more than 1.5%. Stocks across the board were in the red, with miners taking a heavy hit. Nadir Thokan is from SEI Investments. He's been watching the markets. He joins us now. Nadir, thanks very much for your time. Before we get into the markets, I mean, this inflation figure really was eyebrow-raising in the fact that economists had expected it to increase, but not that much. I mean, if you look at on your screen there, year-on-year prices compared to last year, they're quite dramatic indeed. But my question to you is, do you concur? I mean, is the Reserve Bank likely to watch this investment or this interest rate inflation figure and say, well, look, we can't put the brakes on interest rates right now because inflation is worrying? What's your take?
Yeah, so Devan, evening, and thanks for having me. I think that's going to exactly be the Reserve Bank stance. I think that they're unfortunately not left with much option but to increase interest rates and continue the momentum of increasing interest rates. Remember, it's something we've seen since November of last year. That, the Reserve Bank has already hiked by 1.25 percentage points, since the lows of November last year. The escalating inflation is in line with the rest of the globe, as you mentioned earlier on in the snippets. And we've seen how the rest of the globe has reacted, particularly, the US Federal Reserve hiking interest rates by 75 basis points last week Wednesday. So, they certainly seem to be doing their part in terms of tightening their grip on inflation, or trying to tighten their grip on inflation after a lot of market participants accusing them of being behind the curve. I think the South African Reserve Bank, should I say, they don't have the same luxury as the Federal Reserve. They really can't afford to get behind the curve of inflation. The source of inflation, as we know, is cost push. You put up the graphic earlier on. I mean, the sunflower oil prices, cooking oil prices, those petrol prices, diesel prices. Those are seeing year-on-year increases of 50%. And unfortunately, those are the parts of the basket which the poor of this country are the most exposed to. It really is something that's, the Reserve Bank, I think, is going to try and counteract with further interest rate increases. They have to try and defend outflows out of South Africa, given that interest rates all over the world are going higher. So it really is a precarious kind of outlook for the South African consumer, Devan, who's already under a lot of strain.
And this inflation worry really is related to what's been happening globally as well. It's not just South Africa. It's the reason, I would imagine, why we're seeing markets so volatile at the moment. Positive for the last 2 days locally. We're now back into a stretch of negativity. And again, inflation worries, economic growth worries. I would imagine that's what's driving the global markets and indeed locally at the moment.
Yeah, no doubt about it, Devan. So it's really the macro news and, the talk of where central banks are going to go with inflation, with interest rates, given where inflation is printing, and what that ultimately means for the global economic outlook. Interesting to note that the majority of economists now actually believe that the US is going to go into recession this year. Who would have thought we'd come here, given, the kind of robust spending we saw coming out of the COVID crisis. This concern about recession, concern about stock market valuations, that have been kind of kept artificially high, particularly globally, on the back of this massive wave of liquidity, is really what's causing all this volatility in equity markets. Remember, higher interest rates mean higher discount rates, and higher discount rates are very bad for equities, particularly those equities delivering a big part of the value of their company in profitability 10, 15, and 20 years out into the future. When you discount those cash flows back at these higher interest rates, it gives you a significantly lower present value. So, that's why we've seen the growth shares coming under the most pressure, because those are the ones that are delivering the biggest part of their value far out into the future. It really has been volatile going, Devan, and I think it's going to likely continue to be volatile going for some time to come. And these big swings are something we're going to have to become accustomed to. I think South Africa is a fairly better position than the rest of the world to kind of weather some of these storms, because valuations here are more reasonable. But having said that, globally you can get more diversification. In South Africa, it's really about the mining shares. There's maybe one or two shares outside of the mining space in the consumer space. But, our economy remains under pressure.
Yeah.
Yes, GDP growth surprised on the upside, but interest rate hikes, it's yet to see what impact that has on the economy. And the mining shares obviously is very tied to the commodity cycle. And if the global economy goes into a recession, that's very bad for commodity prices. So, it's kind of all of these factors that are feeding through into much more volatility.
Okay, I'm going to leave it there because time, unfortunately, is against us. There was a lot more to talk about, but we'll catch up another time. Nadir Thokan from SEI Investments, thanks very much indeed for talking to us. Let's put some meat on that, give you the numbers of today's market activity.